The U.S. stock market closed out 2022 with its worst year since 2008. All three major indexes all saw dips, with the Dow down nearly 9%, the S&P down over 19%, and the Nasdaq dropping more than 33% this year. The New York Stock Exchange is set to reopen for the new year on Tuesday.
What if we tell you that the future of the stock market seems more vulnerable than it is today? It's no secret that the market has been volatile in recent years, with ups and downs that can leave investors feeling uncertain. Many stock market experts predict that the worst is yet to come, with the S&P 500 might fall 24% from its current position. If you're an investor in the United States or anywhere else in the world, 2022 has been a tough year. The S&P 500 has fallen by a staggering 17%, and the tech-focused Nasdaq has suffered even more, dropping a whopping 30%. The world of cryptocurrency has also been hit hard, with many coins seeing significant declines. Even meme stocks like AMC and Bed Bath & Beyond have imploded. As if that wasn't enough, there are also signs that the housing market may be in trouble. It's no surprise that many investors are feeling anxious and uncertain in this tumultuous market. However, the stock market is predicted to be in more danger in the year 2023, and it looks like investors could be in for a rough ride in the near future. According to Bank of America, the markets are set to be hit hard by a recession in the coming year, with the benchmark U.S. stock index potentially plummeting 24% from its current position. Moreover, an economic downturn could trigger a dramatic correction in stocks as early as 2023. Even though the S&P 500 is already down 15% year-to-date, the bank's analysts predict that it could fall as low as 3,240 points, a drop of around 20% from its current level of around 4,100. That's a significant drop that could shake things up in a big way. The S&P 500 saw a significant drop of around 25% between its January peak and October low. And things could get even rockier as the Federal Reserve tries to slow down the economy. According to Bank of America, there could be more downside ahead. Savita Subramanian, the bank's head of U.S. equity strategy, has predicted we think the market could drop as low as 3,000 based on a panoply of indicators, given a host of risks we face as payback continues and a recession unfolds. Moreover, the bank warned customers on Monday that the index might fall to 3,240 by April 2023. Reaching that level would be a 24% decline from the S&P 500's closing price of 3,958 on Tuesday. And it's not just a recession that we have to worry about. A host of factors, other than disappointing earnings, could also contribute to market volatility, including rising interest rates, skyrocketing inflation, ongoing geopolitical tensions, and environmental concern. These issues, along with a potential recession, could spook investors and lead to a rocky year for the markets. To have a better understanding of the crashing stock market, let's dig deep into these factors. High inflation and interest rates. The annual U.S. rate of inflation was 7.7% in October 2022, dropping from 8.2% a month prior. These are concerning data, and they play a significant role in why inflation has emerged as the number one enemy of consumers, investors, and the Federal Reserve in 2022. It's well known that when rates go up, it becomes more expensive for companies to borrow money to fund growth, which can be a drag on the market. Inflation has already prompted the Federal Reserve to raise its target Fed funds rate to a range of 3.75% to 4%. And Chairman Jerome Powell has indicated that there is more work to be done to get inflation back on track. According to various other stock market experts, there is a very real possibility that we could see more interest rate hikes in the early months of 2023, particularly if inflation remains high. The stock market may be in peril as a result of this. Geopolitical crisis. Geopolitical tensions have also been a major concern for investors in recent years, and the invasion of Ukraine by Russia has been a particularly worrying event. This conflict has caused widespread disruption in global financial markets and remains a major wildcard for investors. In a worst-case scenario, some have even feared that this so-called proxy war between the U.S. and Russia could escalate into a full-blown nuclear conflict. Even a Russian victory in Ukraine or the annexation of Ukrainian territory could be enough to trigger a sell-off in the stock market. In addition to the ongoing conflict in Ukraine, there are escalating tensions between China and Taiwan that could put U.S. supply chains at risk. The Balkans region has also been a source of concern, with saber-rattling between Serbia and Kosovo, raising the prospect of military conflict. And the last midterm elections in the U.S. were also a major political catalyst for the markets, as voters split Congress between the two main political parties. All of this demonstrates how geopolitics can be unpredictable and complex, and how unexpected developments in these fields frequently result in market-disrupting shocks. Supply chain disruption. Adding up, inflation has been a major concern for investors in recent years, and the disruption of global supply chains has played a significant role in driving up prices. China, Russia, and Ukraine have all been particularly affected, with strict lockdowns in China leading to supply issues for U.S. suppliers, and periodic disruptions in the supply of oil, gas, wheat, and other agricultural products from Russia and Ukraine. All of this has contributed to a volatile market and made it difficult for investors to predict what the future holds. Supply chain disruption has also created enormous problems among investors, and it looks like this trend could continue into 2023. According to a recent report from SAP SE, 52% of business executives believe that their supply chains need much improvement, and about 33% expect supply chain headaches to last until mid-2023. This is a significant risk for U.S. companies that are reliant on international suppliers, and it has contributed to a market crash. Cryptocurrency crash. The collapse of FTX, a prominent cryptocurrency company, has sent shockwaves to the crypto market as we head into 2023. This incident has significantly lowered the value of the global cryptocurrency market, which peaked at more than $2.9 trillion in November 2021, and has since dropped to less than $880 billion in November 2022. As investor confidence erodes, investors are selling their crypto holding, which caused a run on the biggest crypto exchange in late November. For instance, Bitcoin's price increased to above $20,000 immediately before the FTX meltdown. Days later, as investors fled the market because of the FTX crisis, Bitcoin prices dropped to roughly $16,000. This is a major shift that could have significant consequences for investors, and it highlights the volatile nature of the crypto market. Besides that, according to Mike Wilson of Morgan Stanley, Wilson, who has an S&P 500 year-end target of 3,900 for 2023, warns that corporate America is preparing to announce downward earnings revisions that could have a major impact on stocks. Wilson, who is also the company's chief investment officer and chief U.S. equity strategist, predicts that the S&P could fall as much as 24% from its closing price on Tuesday in the first quarter of 2023. You should expect an S&P between 3,000 and 3,300 sometime in probably the first 4 months of the year, he said. That's when we think the deceleration on the revisions on the earnings side will kind of reach its crescendo. In conclusion, it appears that 2023 may be a difficult year for the stock market, with a variety of concerns causing economic uncertainty. It's important for investors to stay informed and be strategic with their investments in order to navigate these challenges and come out on top. While the future may be uncertain, there is always a potential for a comeback. And by staying informed and making smart investment decisions, you can position yourself for success in the face of any market challenges. That's all for today, folks. What factors do you think will have the biggest impact on the stock market in 2023? And do you think it's possible for the stock market to bounce back in 2023? Or are you more concerned about the potential for a crash? Share your thoughts with us in the comment section down below, and don't forget to like and subscribe. Thank you for watching,